Greetings and hello to everyone. This is the Business of Betting podcast, and I'm your host, Jake Williams. Today is episode 21, and we have a very special guest, Victor Haghani. Victor is very well known in the finance and investing world. He started out at Salomon Brothers before moving on to places including John Meriweather and Long-Term Capital Management. Currently, he is the founder and CEO of Elm Funds. Victor joins the podcast to chat about a myriad of topics, including his recent research paper and experiment titled Rational Decision-Making Under Uncertainty. We discuss the results of the experiment with a biased coin, 60% heads versus 40% tails, and the optimal bankroll and money management techniques for betting, wagering, investing, and gambling. Is it possible to lose long-term when picking 60% winners? Can you bet too little or too much when the outcome is 60-40 in your favor? We discuss this and more. As always, you can find us at businessofbetting.com or at bettingpod on Twitter. Please fire in any questions or feedback and potential guests you would like to hear from. So thank you for listening, and I hope you enjoy my chat with Victor Haghani. Today, it's a great pleasure to have Victor Haghani joining the show. Victor, thank you very much for your time.
No, it's a pleasure. Good speaking with you, Jake.
Victor, normally we have professional bettors or, we've had sports betting, hedge fund CEOs come on, those with a bookmaking past, those who've worked in, large syndicates and others. Today is a bit of a different tact for me, and certainly a great pleasure to have someone of your caliber and an investment expert and involved more in the stock market side of things. So, why don't you start by just giving a little bit about your background for those who are unaware?
Okay. Well, I started off working at Salomon Brothers in sort of the heyday of deregulation and financial innovation. Back in 1984 was when I started. And my career just went alongside some really great colleagues that taught me and brought me along. And eventually I became a founding partner of LTCM and stayed there through the end and into a short while into the successor operation with John Meriweather and a bunch of friends and colleagues. And I took a break, and about 6 years ago, I decided to start a business that would help people to invest in ETFs and index funds, kind of putting portfolios together of ETFs and index funds in a sensible way, an approach we call active index investing. We charge relatively low fees and try to give people an efficient, tax-efficient, risk-efficient, cost-efficient exposure to markets. So that's my background in a nutshell. I love doing financial research and learning and exploring, and it's been a great journey that continues.
So the reason I came across you was not because I was looking to invest, and it wasn't because I was interested in, trading stocks or understanding some of those aspects. I saw your paper last year called Rational Decision-Making Under Uncertainty, Observe Betting Patterns of a Biased Coin. And I read through that, and it was entirely fascinating for me to understand the experiment, what you conducted, and go through some of the findings that you had and how that applies to whether it is sports betting, whether it is horse racing, whether it's just, betting and investing in general. And I guess even if you could have this scenario with casino games and things like that, there's a million permutations going through my mind. So I want to spend the bulk of our time going over that and some of the insights and I guess learnings that we can garner from your research and the time you spent. So why don't you, for those who haven't read the paper, and I'll certainly put a link to the paper, and I urge everyone who's listening to this who's interested in the business of betting to read the paper. It's not incredibly long, but it's very valuable insights to some of the, I guess, human elements of betting and money management. What was the experiment about?
Well, the experiment, which I did with my research colleague, Dewey, was to explore how people would wager on a coin that we told them was biased to come up 60% probability of coming up heads. And we actually gave people real money and told them that we were going to pay them off if they won however much they won up to some maximum, and then we would tell them what the maximum was if they got close to it. So we gave subjects, we had 61, ultimately I think we had 61 subjects that participated in the experiment. They were generally young, quantitatively trained people. A number of them were students, but we also had about 20% or a little bit more were professional investors. And we gave each one of them a $25 stake and allowed them to bet however much they wanted, however much they had, or fractions thereof, on this biased coin that was set up online for them to play. And we set the cap at $250. So if they won, if they turned that $25 into up to $250, we would pay them out the $250. And they would find out about that cap, as I said, if they got close to it. So that was the experiment. And we asked the participants not to confer with each other. That wasn't always enforced well enough. But that was the basic experiment, was to see how people would bet. Would they always bet on heads? We didn't even really wonder about that. We assumed that everybody would just keep on betting on heads. We were more sort of wondering how much they would bet, whether they had heard of the Kelly criterion and things like that. But the results were somewhat surprising to us.
So what about timing? Did they have unlimited time to try and reach the cap, or what did you say to them when they got there about how long? And
yeah, so they had 30 minutes that we gave them to play. 30 minutes, and we set up the coin. The coin on the computer flipped at such a pace that if you played fast, you could get in 300 flips of the coin. That's that number I'm sure of. So we had a number of participants who did actually manage to flip the coin 300 times, but we didn't set it up so that you could flip it 1,000 or 2,000 times. So there was a bit of a delay. Once you made your bet and pressed flip, it flipped for about 5 or 6 seconds, and the result of that is that you could get about that many bets down if you played efficiently.
So the reason it was of such great interest, and I sort of touched on a little bit before, was that hitting 60% sort of for a sports betting professional it's certainly not likely, it's not common, but it's not impossible. The break even in general for sports betting is around 52.5% when you factor in the bookmaker's percentage or the takeout or the vigorish. But it's, like I said, it's not impossible for someone to hit 60%. There's a very large NFL handicapping competition in Las Vegas every year called the Super Contest at the Las Vegas Hilton. I think last year there was almost 2,000 people entered, and the winner went about 65 or 66% over that season. I think there was about a bit over 80 games. So that sort of show, and there were a lot of participants in that competition that went around 60% or even above or a bit below. So that's sort of where it piqued my interest, and I was sort of thinking about, well, there's not many situations in my life where anyone's going to come up to me and say, here's a coin, it's 60% heads likely and 40% tails likely. Go for it for 30 minutes and you can start with $25 and see where you end up. So I guess I was trying to think about it from a sports betting perspective, and I guess someone who has excellent handicapping skills, or they have access to a brilliant tipster, and then you give them these tips at going at 60% over a course of a period and to see what happened. And I thought, gee, that would be unbelievable. And I guess some of the basic mathematics that's involved when it comes to having an edge of that level, it sort of compounds pretty quickly over time if you do the right thing. So do you want to sort of, before we get stuck into what happened and I guess some of the results, do you want to sort of talk about the aim or the expectation of the experiment from your side? Did you have any going in?
Well, really just to learn and see. I mean, we suspected that there would be some suboptimal betting, but we were just, we think we were really curious about, what kind of strategies people would employ to how much they wagered. So we didn't have really firm expectations, or if we did, it's hard to remember what they were because they got shaped by what ultimately happened.
And so did you have any just regular people off the street come in, or were they all sort of relatively well educated? They were either in finance or looking to get into finance?
Actually, we had a number of quote unquote regular people, or I should say, quantitatively trained people do it also, but they tended not to be in our sample. Like I had my mom do it when we were testing out the program to make sure it worked. Like we had a couple of receptionists from our office building come and do it, but we didn't put them into the sample, and they didn't do, they wouldn't have changed if we had put them in the sample, they wouldn't have really changed the outcomes either. So yeah, I mean, it would be great to be able to do this with a much broader sample of people. I mean, the problem is that it's expensive.
Yeah, right.
Even when people aren't doing a great job of it, it's like you're paying everybody, you're paying $100 a person to sort of participate in this experiment. So, it's hard to make sense of, if you're going to if you want 1,000 people sample, you're talking about $100,000 as the cost of what you're paying to people to do it.
Yeah, I guess that's true. I guess if a casino accidentally came up with this scenario within one of their establishments, they probably wouldn't even pay you out, or they'd find a way to avoid it. And I probably should have come up with a more apt description for people like me rather than just regular people. But anyway, so what was the outcome of the experiments, the results, and I guess the performance of those who took part?
People, in general didn't do very well. I mean, I don't know, probably the two most surprising things were that there was a lot of betting on tails that went on. So people kind of had this feeling, this fallacy of control, or that they could somehow predict when the tails would come up. And then also just a lot of people went bust, around a third of the people actually went bust, and more people went bust than hit the $250 maximum. So yeah, it was surprising, and that there was kind of very little proportional betting. I mean, you would kind of think that people would kind of intuit, I should bet a proportion of my stake each time. But there was very little. I mean, it's hard to tell because, people are playing fast. And so if somebody says, I'm just going to bet 10% of my stake every time, it might be hard to observe that because they might not exactly bet 10% of their stake every time. And so it might look a little bit, more jagged than that. But we tended to not see people really sticking with any particular percentage either. So yeah, it was kind of surprising. I mean, a lot of finance people, nobody sort of had the Kelly rule in mind or anything like that. So it's like all these people trained in finance, and none of them that they weren't led to a simple proportional betting rule, and they didn't have any kind of base. They didn't have like a base to sort of start with, like what would be, they didn't have something like Kelly just there to draw upon and say, well, I'll just bet 20% or 15% of my stake each time and sort of see how it goes. So it was surprising like that. It was under pressure, that people realized they didn't have a lot of time to think about what they were going to do because they were using their time, their betting time, but still, we were surprised by all that.
Yeah, it is unbelievable. If I said to you, I'm going to gather the 5 best sports bettors in the world, give you all of their tips, over a season of English Premier League soccer, and they're going to hit about 60% because they're incredibly good at what they do, and then you told me at the end of the season you went bankrupt, that would be hilarity would ensue. That just seems incredibly difficult to do if that was the scenario, and essentially a third of the participants went bust. Is that as crazy as it seems, or do you think that pressure and I guess the being put in that situation without too much time to think caused such an outcome, or were there other factors at play?
Yeah, I think that it's more explicable when you think about the circumstances, the pressure, the boredom. When let's say you got down to $1, you might say, okay, I got $1, and I really that I don't care if I lose the $1, but I'm going to bet aggressively. So they would bet say 50 cents on one flip, and then it's like, all right, now I've just got 50 cents left. Oh geez, what am I going to do? I'll just bet the whole thing and then go bust. But there was one. I was having coffee with a guy who was a professional poker player, though, and I just told him about the experiment and asked him what he would do, and his first reaction was he said, "Oh, I would go for the highest expected gain. I would bet $25 on each flip." And I kind of looked at him, like, how could you come to that? And I was really surprised. I didn't have him participate in the experiment. It was just, this anecdotal piece. But I think a lot of times people's first reaction is, I'm a risk taker. I'm going to go for the highest expected gain approach to this thing because it's not a lot of money. And so, I'm sure that this professional poker player, would play poker, that in the context of his professional gambling, I'm sure that he would be very sensible about how he bet, but sort of placed into this other experiment, into this other context, he gave kind of a silly answer. So I think it takes a little while. So I think that any professional sports bettors that are listening to this, know exactly what they're doing and would in their own betting. I'm sure that they're betting in a very sensible way, with some sort of modified Kelly rule, whatever. But it's interesting that it's just how non-intuitive it is for people just thrown in to the situation and trying to figure out what to do. Even for your audience of professional bettors who are all, I'm sure, well aware of Kelly and that sort of thing, I think there's still a lot that's interesting here and in other related research that we've done as well.
Yeah, absolutely. So what was the Kelly number that came out when you did the mathematics behind it? What did Kelly say to bet? Was it a certain percentage of your bankroll, and what was that percentage?
Yeah, Kelly is 20% in this case. It's 2p minus 1, where p is the probability of winning. So 2 times 0.6 minus 1 is 20%. So that's the Kelly bet. And, there's reasons where you might want to bet half of Kelly or a third of Kelly, so you might want to bet 10% or, depending on the circumstances. I mean, one of the interesting lines of research that came out of our note was people saying, well, what really is presented with this game? What's the optimal thing to do? And you need to take account of the fact that you have outside wealth, that there's a cap on the game, et cetera. And so there was a lot of, there were a number of research papers that other people wrote that were very interesting. Actually, you probably know of Aaron Brown, who I think he wrote the book, The Poker Face of Wall Street. Have you ever read his stuff or talked to him on your podcast?
I haven't spoken to him, but I'm aware of some of his work. Yeah.
Yeah. So he wrote a paper that he published that sort of tried to solve this game in a more general way, taking account of its specific boundaries and all of that. So that's really interesting. Is sort of, what do you do when you're faced with a nice opportunity, but you're not really going to put all of your wealth, but you have outside wealth that you can't get into the game. And how do you play it under those circumstances? And that's a pretty interesting problem.
Yeah, certainly. So if Kelly says bet 20%, and a lot of my guests would say they might only have a quarter Kelly staking plan or a half Kelly. Some have even said they have, separate bankrolls where they do modified Kelly in one and straight Kelly in others and things like that. What do you think would be the optimal, percentage to bet? If Kelly's 20%, are you thinking it would be, I think you mentioned 8% earlier. Do you think it would be around sort of 10% or something like that now that you've sort of seen it happen?
Well, if I were presented with this game today with all that I know and, having had a lot of time to think about it, the key aspect of this game is the key aspect of being a subject in this experiment is realizing that there's going to be a cap on how much the person running the experiment, i.e. me, is going to pay you. So you sit down and it's like, okay, here's $25 and I'm going to pay you as much as you win up to some maximum. The first thing the person should realize is, listen, this guy is not coming in to do this experiment. He's not going to pay me $1 million if I turn the $25 into $1 million. Maybe he's going to pay me $100, $200, something like that. So knowing that there's a cap, really what I want to do is maximize the probability that I hit the cap. And to maximize the probability that I hit the cap, I would go with, and assuming that the cap is down around $100, $200, $300 or $50 or whatever, I should go with something like half Kelly, 10%. So if I were betting 10% of my bankroll on each flip, then, I get to like a 99% chance or a 98% chance of hitting the $250 max. Whereas Kelly would give me the highest growth rate. So if I were betting Kelly, my expected amount of money that I'd have at the end would be like $3 million. But that's irrelevant because I know that I would never get paid out that. I'm not trying to maximize my end value. I'm trying to maximize the probability of hitting the cap.
So what happens in this game without a cap? What is there? There's an expected value, right? There's a certain number that it would reach if you had, the same amount of time, a certain amount of flips, the 60-40 split on the coin and the percentages of heads coming up and tails coming up. What is that expected value of this game?
Well, so the expected value, if you went in and bet Kelly, is about $3 million, uncapped. But I think that most people, again, I think that the Kelly risk aversion log utility is less risk averse than most people actually are. So, I would imagine that most people, if you were playing, most people that might play this game uncapped, would be betting, going with something that was some fractional Kelly betting thing. Another question that we asked was, how much should you be willing to pay to play the game uncapped? And which is another interesting question. And we sort of came up with numbers of $10,000 to $50,000, which would be the utility, the expected, the dollar value of the expected utility of the game. So uncapped, it's worth a lot. But as I say, I think uncapped, people would probably not play it, Kelly all the way, because playing it Kelly all the way, you get to a point where you've got a lot of money in the game and you might not really want to bet 20% on a 60-40 flip. When you've got $5 million in the game, you might not be willing to put $1 million on the line for your bet.
Right, of course. Can you go into sort of the utility aspect of it? Because I'm thinking in my head, if I, had, I don't know, let's say I had Bill Gates and Mark Zuckerberg in a room and they were feeling very friendly and they said, look, you can play this game uncapped. We'll put a smart contract in place. So whatever the number is at the end of the time you want to play and you press finish, that will be automatically sent to your account. And I was pretty comfortable that I was going to be paid in that situation. Can you just sort of explain a little bit about the utility and what exactly that means? Because if it was a restricted scenario where the expected value was $3 million, obviously the utility is going to be a lot less than that. And there's other factors that go into it, like, is this all the money you have in the world, and are you going to get paid and things like that. But what if there was a scenario where it was, Bill Gates and Mark Zuckerberg allowing me to play, and there was a smart contract where they couldn't necessarily opt out and I could get that money in my account? What's sort of the utility in that sort of crazy scenario?
Right. So yeah, in the scenario where the money that you have in the game is all of your money. So so maybe you've gotten to a point where you've got several $1 million in the game, whatever, and that's everything that you've got, and you're not worried about getting paid off. So then it becomes a question of your personal degree of risk aversion. And so it becomes a question of what's your, personal utility function. And Kelly is, the Kelly criterion is consistent with an investor having log utility. So that means that they value different levels of wealth equal to the natural log of that wealth. Most people, most observers believe that most people are much more risk averse than Kelly, than log utility, I should say. And so again, imagine that you're in this scenario where you've worked your way up to $5 million. You've got $5 million of bankroll. It's all the money that you have, and you can bet as much of it as you want on the 60-40 flip. I think that very few people would say, all right, I'm going to bet $1 million on the 60-40 flip, which would be the Kelly bet, the 20% of 5 million. And I think that, what you would find is that people would be more thinking of betting $500,000 or half Kelly or, $350,000, a third of Kelly, that sort of thing. Yeah, but it's really, it's really down to personal preferences and kind of thinking it through. I mean, the thing that's so interesting about playing the game and is what does it feel like? And so your sports bettors, right? These guys that people that are playing a game where they think they have a 53% chance of winning. It's even more extreme in those cases. But, when you're flipping a 60-40 coin, it is really surprising how random that baby feels. I mean, you think that it's like, so another experiment that we did more recently is we asked people this question. We said, and I don't know if you've read this piece or not that we did. We asked people, we said, imagine that you're presented with two coins. One of them has a 60% chance of landing on heads and a 40% on tails. And the other coin is a fair coin, but you don't know which one is which. You don't know, you're presented with these two coins and you need to identify which one is which by flipping both of them. How many times would you request to see both coins flipped so that you would be 95% confident of identifying the biased from the unbiased one? And have you read that one, Jake? That piece that we wrote, or
I have it saved, and I'm going to read it in the next couple of days. I'm just thinking in my head if I was.
Yeah. Okay. So you can give us kind of an unbiased answer to that question. And what I'll tell you before you answer it is that people guess way too low a number of flips. People feel like we would get people telling us 6 flips would be enough, 10 flips would be enough. That if I could flip both coins 10 times, the 60-40 coin and the 50-50 coin, that after 10 flips, I would be pretty comfortable identifying the biased one from the unbiased one. And I think that, with a moment's reflection, you can see how that's crazy, right? I mean, there's no way that 10 flips is enough. It's going to take a lot more than 10 flips, but people's intuition, people would tell us 6 flips. We got a lot of people say it would be 6 flips, and then they might think about it more and say, oh, sorry, that was way too low of an answer, but that was after they pressed send and we told them the answer. So I think that's one of the most, to me, that's one of the most interesting parts of this experiment is getting a simulated experience of what it's like to bet on a 60-40 coin. And it just, like the chances that you get 3 tails in a row and lose a lot of your wealth. Because remember, if you get 3 tails in a row and you're betting 20% of your wealth on each flip, right? You've lost half your money.
Yeah, I've heard you touch on this in the past. So we've spoken about sort of Kelly at 20%, going lower, and why 8, 10, 12, 15% might be a bit more optimal for preserving your wealth, I guess, and having a little bit of security. What about when you go up towards 30, 40, even 50% of your wealth and betting that much of your bankroll on the coin? Can you talk us through sort of what are some of the outcomes that happen when you get up to those higher numbers, up towards 50%?
Sure. Yeah, absolutely. So, sorry, just to close on, because I think I left our listeners hanging on how many flips you would need. I think the number is like 140. It's crazy, or 120. I'll have to look at our
I was
paper.
thinking like maybe if I'd flipped it 20 times, I was thinking, well, if I flip it 20, would I get 12 and 8? Maybe not, actually. Maybe I would need like 30 or 40 or 50. So I'm not even close. Yeah,
it's just a human. It's a human bias. It's just the bias in our heads that we need. That we just can't accept. We can't accept that the truth isn't revealed in a small number of outcomes. That we want the story to be told to us without having to wait 100 years. So yeah, it's over 100 flips in the case that I gave you. I think what you're referring to in this other case or this other question about, as you're increasing the percentage that you're betting, right? Is this aspect of when you're betting some fraction of your wealth, that winning 3 times and losing 3 times leaves you worse off, right? So, if you're betting 50% of your wealth on something and you win and lose, right? You're down at 75. You've gone from 100 to 75, right? Because you go from 100 to 150 because you won, and then when you lose, you go from 150 down to 75. And it doesn't take too many times of winning and losing, winning and losing, winning and losing before you basically have wiped out 99% of your wealth if you're betting 50% on each flip. And so these distributions get very, very skewed. The median of the distribution keeps going down even as the mean of the distribution goes up. So, think about if you're flipping a fair coin, there's a 50-50 coin, then any flipping strategy that you have, your expected value is your starting value. So if you have $100, you can bet it any way you want on a fair coin, and your expected end value is $100. But if you flip 50% of your wealth on each, if you bet 50% of your wealth on each flip of that 50-50 coin, then your median wealth is going to go to zero. So, right, because of this whole win-lose thing, that's where your most likely value of your wealth is going to be down at zero, but the expected value is still at 100. So that means that you've got a small number of cases where your wealth is $1 million or whatever, and it averages out to 100, but the most likely outcome for your wealth is you're down close to zero.
That's eye-opening, isn't it? That seems like, for me, who hasn't studied this in depth, it seems crazy. You basically, I guess you're saying that the chances of getting a really high amount is lower compared to the median, right?
Yeah, the chance of getting a really high amount. I mean, yeah, exactly. Yeah, no, it's interesting. Yeah, definitely. And
that is bizarre. Just thinking about it, sort of, if you had 30 seconds to think about it and give an answer, if you want to talk about what's the median, I guess, expectation for a 50-50 coin versus a 60-40 coin, it's hard in your brain to sort of compute that quickly and say, okay, I think that's what's going to happen. That's bizarre, but I guess that's just, it's incredible. I guess that's sort of we can talk about over betting and I guess bet sizing and things like that. It gets pretty problematic. And I was sort of thinking about it, how on earth do people lose betting long term if they've got 60% sort of tips in their back pocket or they're handicapping at 60%? It's quite easy to lose all of your money. Yeah.
No, it's surprising, right? Because it's kind of in some ways the easiest, that you would think that the hard thing is finding the 60-40 coin, and the easy thing is figuring out how much to bet. I think that you could sort of flip it around and say, actually, there are lots of things that are more like, there aren't a lot of opportunities to make 60-40 bets many times a year, but you can do a 60-40 bet once a year. That's just probably investing in the stock market is generally a 60-40 bet once a year. And actually, but getting your bet size correct or what's appropriate for you is really difficult, and so like if you read investing, if you read about investing advice, telling people what to do, there's a lot of advice out there about, keep your costs low and be tax efficient and all of that. But there's very little that's said about, what's the right amount of risk that you should be taking? How much money should you have in the stock market? And because the reason for that is because it's kind of a personal and difficult thing for people to get their heads around. So there's it doesn't have such an easy answer for people, and it's highly personalized.
Yeah, absolutely. So were there any sort of implications, or did anything jump out at you or your team when you were doing this? Or was it as simple as, look, you just got to stop and think about things a little bit, certainly when it comes to managing your bankroll and investing your money and I guess, sort of money management overall? Was there any sort of real life sort of strategies or implementations that people can think about? Or was it just, you've got to really carefully study, I guess, the situation and what you're getting yourself into?
Yeah, I mean, I think that the big implication of this is that people need to spend more time thinking about how much they should put at risk rather than what they should buy. That when it comes to investing anyway, that balance is too much. The balance is too far skewed to figuring out what are the good opportunities rather than putting time into carefully thinking about how much of those things should I want to own. And and I think the other thing that's kind of come out of this is this related bit of research of just how difficult it is to identify small edges. That in the context of sports betting, right? I mean, if you've got a 52% edge in your sports betting, how long does it take you to decide, how long would it take you to decide that you do have a 52% edge? How many bets would you need to make to decide that? And I think the answer to that is really in the thousands. You would need to make thousands of bets. That if you did have, that if you were trying to identify a sports bettor who had a 52% edge from another one who had, say, 0 edge, you would need to observe thousands of bets from the two of them in order to identify which was which. Just as you need over 100 to identify a 60-40 coin versus a 50-50. And I think that's really interesting because I think that people just feel like, we can use much shorter track records or much shorter, that much shorter track records will give us enough comfort in identifying the gems from from the rocks.
Yeah, absolutely. And I do ask a lot of the guests about how they go about calculating their edge, if they are using a percentage of their bank for their bets and things like that. And I guess a lot of the answers are that it's sort of feel and it's, using your experience and having that sort of training over the years, which I guess is the only answer, and it might be a good answer, but I guess based on what you've said, certainly, and also other sort of behavioral finance and economic principles that are out there with regards to sort of overstating how good you might be in certain circumstances, it's probably very easy to get in trouble when you're trying to calculate what your edge certainly might be in certain circumstances. And if it takes hundreds or thousands of examples to get a good grasp on what that might be, you can certainly get into trouble very quickly.
Yep, agreed.
So you mentioned Ed Thorpe in your paper. Can you just maybe touch on what interaction you had with him and what he said about the experiment in general? Because I know he's a rock star when it comes to, obviously, his book about card counting and his time in investing and I guess just in general. So do you want to just touch on what Ed had to say about all of this?
Well, I mean, we were very, very pleased that Ed took a look at it. My co-researcher Rich Dewey, has a nice relationship with Ed, has met with him a few times, and and Ed was happy for us to use a quote that he sent us in an email, where he said that he felt that our research and the kind of experiment that we did should be part of the training for anybody that's serious about investing or gambling. So I think he liked what we did. Obviously, he's written the book along with other of his friends and colleagues. They've written the book on this topic, and but he thought that we had an interesting, and worthwhile perspective on it. So we were super pleased that he liked what we did.
Yeah, that's great. He is a superstar in the area, so I guess it's very cool when you can have someone like that give you the thumbs up. It would be remiss of me not to ask one or two questions about investing, and I'm certainly no expert, but I've read some of your work and I found it interesting, some of the topics you were writing about. So forgive my inadequacies when it comes to the knowledge in this area, but two brief and quick questions for you about investing. And obviously, it's not financial advice, and the listeners sort of know this when we talk to all of our guests. It's just sort of their thoughts and theories and ideas. There's a lot of discussion here in the US about a debt crisis and a potential recession and things like that. I saw you wrote about it recently, about waiting for a, I guess, market correction or whatever the right terminology is. Do you want to briefly summarize sort of your thoughts on this area?
Well, I guess the short note that we wrote recently was just trying to lay out what the historical record was, and not to. We tried to be very explicit about saying that we don't think that history predicts the future, but we thought it's important. It's even more the case that not history, that things that didn't happen are not going to be very predictive either. So that to say that history doesn't predict the future doesn't mean that not history predicts the future. I mean, not history, doesn't predict the future either. So that was kind of where we were coming from, because we had the impression that a lot of people have this idea that when the market is expensive on our main valuation type metrics like price earnings, that corrections tend to come frequently and save investors or wind up making investors better off. And so, in general, my view is that in the short term, it's very hard to predict what the stock market's going to do, or asset prices in general in the short term, in the 1 month, in the 1 year type of region. However, in the longer term, in the very long term, I think that it's somewhat easier to predict returns, or the error around predictions tends to be less. So, if you're looking at a 30-year bond and you look at it to a 30-year horizon, well, the return is going to be pretty close to its yield. And similarly, if you look at the stock market and you think about a 30-year return, the 30-year return is probably going to be somewhat related to the earnings yield, the earnings yield of the stock market at the beginning. And and historically, we don't have a lot of data, but that seems to be supported by history also. That if you're buying companies that have an 8% earnings yield, that over the long term you're likely to make something along the lines of 8%. And as I say, that's in the very long term. Now, investors want to feel that they're doing well in the short term, and unfortunately, that's just really, really difficult. But if we look at the long term, we have a better chance of getting a handle on expected returns, and that can drive our investing decisions. So today, the markets are very frothy. The U.S. market's gone up a lot. There's a lot of signs that people take away or parallels with periods in the past that came before big sell-offs in the market. But, my feeling is that could well be the case, but I think it's very hard to know, and I would rather try to focus more on the long term and recognizing that long-term expected returns of the stock market right now are much lower than they've been at other times, leads me to want to hold less equities, but it doesn't lead me to want to hold zero equities or to be short equities, which I think is what you would get if you actually thought the expected return was zero or negative. So when PEs are high, expected returns tend to be lower, but probably still positive over the long term, and the short term is very hard to predict.
I really appreciate that insight, and I'm really grateful for your time. One last question. Behavioral finance aspects that we haven't necessarily touched on too much, but are in play when it comes to these sorts of areas that we're talking about, whether it is the betting side, investing side. I know a lot of us are interested in resources and I guess different books to read or different ideas that they can use that are utilized in different areas of investing or trading, or the stock market, whether it is horse racing, sports betting. Can you sort of point people who are interested in trying to find out more information about some of the behavioral finance or economics aspects that are in play?
Well, I mean, there's so much great stuff that's written and compiled in different ways. I mean, books by Thaler, there's so much out there. It'd be hard to think about where to begin. I mean, I see a lot of copies of Thinking Fast and Slow Kahneman's opus out there. I mean, I think any of these books is a great starting point, and then there's references throughout, and there's a huge amount of overlap. It's a fascinating field, and there's a huge amount of overlap between different books. So I think you sort of just dive into one of them, and there's so many great ones out there, and that's a really great that's more than a starting point in terms of understanding all these things and seeing how they might apply. So I guess the idea would be to go with a more recent book, so that it's covering, all the latest research. So as I say, something like Kahneman's Thinking Fast and Slow or others. And, the researchers themselves have written a lot of these books, as I say, Thaler or whatever. And so it's kind of nice to read the stuff in their voice rather than reading some of the books that have written more by journalists, which also are great. But since the original researchers have written some books, you might as well start with those.
Yeah, absolutely. I came across Misbehaving by Thaler, and then I guess the good thing these days is once you buy a book on Amazon, it tells you another 100 books that you should be buying as well. So I think just getting a start with Thinking Fast and Slow or Misbehaving or one of those preeminent books.
Yeah, and probably just, a book or two is all you need, because they overlap so much. I mean, I would say, that one or two books and you'll be, well on your way, and then can sort of specialize into things that are of particular interest.
Victor, thank you very much for your time. Before I let you go, do you want to just mention Elm? And I guess there's some great sort of content on your site. I've read some of the blog posts you have there, and there's some interesting insights for certainly someone like me who's not day-to-day involved in the investing and this trading side. So do you want to just touch on that and where people can find your work?
Sure, yeah. Elmfunds.com is our website, and we try to provide short pieces on investing that don't really talk about current markets, but more about just different ideas in investing. So yeah, I mean, check out our site. We help people with their savings, in what we think is a sensible approach to investing, low cost and very secure. We manage separately managed accounts at Fidelity, so our investors open an account at Fidelity. We help them to do that, and then we manage it there, but it's their account. It's not commingled. We also have some funds that we manage as well. My email address is there on the website. It's easy to contact us if you want more information or presentations or whatever. So yeah, elmfunds.com, and yeah, thank you. That's kind of you to mention our site. It's we're very interested in research, so it's been a pleasure being on this phone call and talking about ideas and not so much our business, but thanks for asking about our business too.
It's been a great pleasure to chat, Victor. Many thanks again for your time, and I look forward to more of your research and more of your papers and getting a better understanding for myself. So I'm sure the listeners think much the same. So, many thanks again.
All right. Thanks, Jake. Take care.